Hello and welcome to another presentation in our teleseminar series hosted by Rumsey CPAs. We are on the line tonight with David Rumsey, CPA and President of Rumsey Inc., a Marysville CPA firm that provides a wide variety of accounting, tax, and financial management services tailored to meet the needs of business and individual clients. David is also a columnist for the Snohomish County Business Journal with his column Tax Talk, which you can see each month on local newsstands or online at the Snohomish County Business Journal website. The note sheet for the call tonight was sent to you in the confirmation email for the call, or if you're listening to the replay, it is downloadable off the page as a PDF. So we recommend that you have it in front of you as we go through it during the call. And today, or tonight, David is going to be talking about the top 13 mistakes that are made by retirement plan investors. David, good evening and welcome to the call.
Good evening, Jeff. How you doing?
Good, good. And I should also mention that if anybody has any questions, David, you're going to be presenting. If they just press star two on their phone, we can open up the lines and let them into the call. And then afterwards, we'll open up the lines for a little question and answer period if we have enough time. David, thanks for being on the line with us tonight, and I think you're ready to go.
I am. Thank you, everyone, for joining us. I'd like to, again, welcome everyone, and we're going to talk about the top 13 mistakes made by retirement plan investors. We could actually take the word retirement plan out and just leave it at investors. A lot of these areas, I see many people are doing that, so I think we'll just focus on overall the investment. Tonight I'm going to highlight the most common mistakes I've seen investors make with their 401ks, their IRAs, and pension plans. So we'll jump right in it. For tonight's purposes, I'll probably use the term 401k, but please note this could be related to an IRA, a pension, 403b, other types of retirement plans out there. The first one of the 13 mistakes we're going to talk about is the mistake that thinking the 401k is a free account. Today, most 401ks and IRAs are made up of mutual funds, and unfortunately, most investors don't have any clue as to how much their 401ks are costing them. There's different types of fees to be aware of. One, there's an annual expense fee. These are usually in the prospectus that says no matter what, you're going to have a fee just for having the fund. There's also things called 12B1 fees. These are also in the prospectus. They can be anywhere between 0.25% to 1% a year. They pay for the fund's advertising, a lot of their administrative costs. There's sales loads. Simply, you're just going to get a commission charged to you, to the representative for selling your fund or the investments to you. And then the fourth cost is portfolio turnover. The more sales that are going on and turnover in the fund also increased investment costs to you. The biggest problem is these fees, one, add up, and they can easily be up to 2.5% to even 3% per year. So if you average a 7% return but you have 2% in fees, that's a 5% return when all things are said and done. And the biggest thing that a lot of people aren't aware of is these expenses don't show up on your statement. No, they're taken out of the daily price per share of the mutual fund. So as wise investors, we want you to know exactly what you're paying, and we need to do everything we can to keep the cost down in our investments because that's eating away at your returns. Just like taxes, in many cases, are eating away at people's returns if it's not in a 401k or an IRA. So these are things to be aware of. There are fees, and your 401k account is not free. Mistake number 2 is not having a written investment strategy. We want your money to be managed according to your goals, your objectives, and assumptions, not on hot tips or just winging it. And many people I run into have no investment strategy. They're just saying, I want to make money. I need to save money for retirement, and that's as far as they go. They need to get a little further into it, just like anything else. Over the last 20 years, the burden of responsibility for the employees' retirement accounts have gone from the employers to the employees. Old traditional pensions are becoming fewer and fewer out there, and so we as the investor have to be aware of this strategy. In the early part of the last century, pensions were developed. You didn't have to worry. You just worked, they took care of it, and you got a check every month for the rest of your life. Now that check totally depends on what your strategy and having an idea of what you're going to go from there. Mistake number 3 flows right in after that. Mistake number 3 is not having a systematic formula to determine what type of funds to buy. So these are many things to look at and to think about. Many 401k companies today only offer between 5 to 30 choices for your 401k. Yet it can take anywhere from 6 to 10 asset classes and 8 to 15 types of investments to properly diversify your portfolio. So really, I see it many times that many 401k plans don't even offer enough choices. So even if you invested an equal percentage into each asset class, you still wouldn't be diversified. Now that's something that is unique to every company, but it's important to know that diversification and having that systematic formula to determine what type of funds to buy is a huge thing to focus on, and it's a mistake that many people make. Because remember, there's over 17,000 mutual funds, and those mutual funds invest in literally hundreds of investments, be it stocks, bonds, based on their target or strategy. So it's very important to realize we need a formula to determine the type of funds to buy based on our goals, based on our risk tolerance, and things of that nature to avoid mistake number 3. Mistake number 4 is also a common one I've seen. Investing while looking in the rearview mirror is what a lot of people do. And what we mean by here is gold has been up, let's go into gold. Oil has been up, let's get into oil. Well, if you want to be successful, the key is you need to be in the investment before it becomes hot. Because once it's everyone knows gold's going through the roof, you missed out on the run-up. Now, if you were in gold and had some money invested in that to begin with, you've made money. So the key I've always thought is be in the investment before it gets hot. You can go all the way back to the 80s when things were going through the roof in commodities and precious metals and oil. The 90s, early 90s, you had Japan. Everything was all Japanese. Well, that came and went. Internet. Everyone realizes the late 90s to 2000s, Internet was going crazy. No one could lose any money as long as they're investing in the Internet. That was the hot stock. Well, we know what happened there. It crashed and readjusted going forward from there. Real estate, a common one in the mid-2000s until we had the adjustment in 07 and 08 where real estate values have dropped, and we're still trying to get through that. So the key is be in the investment now. A company named Dalbar reported that from 1982 to 2002, the market averaged 12.75%, but the average investor out there only earned 3.5%. So in other words, the investors typically were selling high or buying high and selling low. They were chasing last year's returns and hoping that it would continue to go, and they put in to products that were high expense and low returns. So, as I said, the key I look at for that is don't worry about what's hot today. Be in a diversified portfolio that you're going to be exposed so when the next hot craze comes, and we know there'll be another one, you'll already be in it and you'll be able to benefit from that as opposed to chasing what happened yesterday by investing in it today. So mistake number 5 is overlapping investments. You may own different mutual funds, but many times I see when you break down what each mutual fund owns, you'll see that they own the same companies. So people are out there thinking, hey, I have a Fidelity fund. I have an S&P index fund. Well, years ago they did an example with Fidelity Magellan and the S&P 500 index fund, and basically they found that over the past few years, 98% of the investments were the same. So Fidelity Magellan, though, was actually a more expensive fund to be in as opposed to just the plain S&P index fund. So we don't see it quite that severe, but many times we'll see, well, this fund's invested into ABC company. Oh, well, so is this one. So if you have 3 or 4 mutual funds, even if they're from different fund families, you may find that, hey, these are actually all investing in the same thing. So on the outside, you look and say, wow, I've got all these different mutual fund companies, but you find they're still all in the same type of companies, and therefore you're still not really diversified. So that's an important thing to look at. When we look at doing a financial analysis, that's one of the things we look at and see, are you really diversified in both asset classes and the type of funds that you're in? Mistake number 6 is a common mistake in many different things, but you're lacking of professional support. So in other words, no one is continually working with you to review the investments, whether it's annually, twice a year. They're not looking at your plan. You're either doing it on your own and just hoping for the best, but having someone to say, hey, we've got to reallocate your portfolio. You're actually looking more aggressive than what you have said over time because of the way the returns were coming in through the investments. That's an important thing. You need to have a written retirement plan that's reviewed at least every couple of years. You need to make sure nothing's changed in your life. Maybe you have an additional grandchild, for example. Maybe you've had a new addition to your own family. These are things that we want to continually structure because, as we all know in life, things change, and having a professional work for you a lot of times will help you adjust for that change and to make sure you're staying on track. Mistake number 7, asset allocation has been a train wreck for 401k plans. And this is really a huge area as well. We've kind of touched on it a little bit. I focused on learning about the Harvard and Yale endowment funds. How do these funds consistently generate positive returns when the overall market has had some horrible years or at best no growth years? Over the last 20 years, the Harvard Endowment Fund has generated a 12.9% rate of return. Well, many other benchmarks and things like that have been 3 to 4% lower than that. So how do they do it? This is a large amount of money that's being invested by professionals, but what is the strategy? If you go onto their web site for the Harvard Management Company, you find some interesting things there. They state the policy portfolio is a theoretical portfolio allocated among asset classes in a mix that's judged to be most appropriate for the university from both the perspective of potential return and risk over the long term. They consistently review it for continued fit with the university's risk profile and for your projections of long-term market returns, volatility, and correlations. Well, we've already talked about asset classes and being properly allocated. We've also talked about risk profiles and volatility and correlations. Correlations is what we were talking about, the overlapping investments. So here is a company that's in charge of investing billions of dollars that will be used to help fund a university. And consistently, they have done well. Has it always been perfect? No, but over a long term, which is the type of perspective that we're working with, they have done very, very well. And the key has been they've spread out the money over various asset classes, be it foreign, be it U.S., bonds, fixed income, real estate, equities, and they spread that money out and they adjust it for risk and what the market's doing. There's a lot more detail and different type of investments in what they're doing. Now, as we said earlier, a lot of 401ks don't have this opportunity for you, but this is the type of thing that you have to look forward to doing and just saying, well, I've got a little bit in bonds, a little bit of stocks, and a little bit in cash. That's probably not going to be appropriate asset allocation, and therefore it's going to cause you some more challenges as far as that goes. investment manager who runs the Yale's Endowments Fund was quoted saying, "Currently at Yale, we have a half dozen asset classes that individuals ought to have in their portfolios. Traditional bonds, inflation-indexed bonds, U.S. stocks, foreign developed stocks, emerging market equities, and real estate securities." He goes on, "The problem with the mutual fund industry is that you've got a sophisticated provider of investment services on one hand, and on the other you have an unsophisticated consumer. This imbalance leads to behavior that lines the pockets of mutual fund managers at the expense of the individual investor." Here's the key. We want you to not be at the hand of the mutual fund managers. We want you to be diversified. We want you to be able to allocate your money appropriately. You've worked very hard to build that, and asset allocation is a huge part of what Harvard and Yale does with billions of dollars and have done very well to reduce their risk and help increase their returns. We want to work with the same type of theory going forward. Yes, it's not billions of dollars, but why aren't you allowed to have the same type of theory and strategy going forward? Mistake number 8 is moving your 401k to a salesperson and not a trusted fee-based advisor. These are things that I think everyone should look for no matter who you're working with. You're interviewing different investments, you get a referral from someone, you talk to someone. These are things that we feel are important. You want to work with someone who's experienced. That's pretty obvious. You want to work with someone that works on a fee-based rather than a salesperson. You want to work with someone that's going to take the time to review your individual big picture and goals. Someone you trust. Someone that doesn't work off a select product list. Many banks and insurance and even investment companies, you can only buy their approved product list or their funds. That a lot of times is not going to give you the asset allocation, and it goes back to mistake number 5 with overlapping investments. So those are things we want to advise you to stay away from. You want someone who's going to work with you in the future. It's not a one-time sale, and they're going to hear for you. You have questions. You want to review your portfolio. Those are important things that we have learned that needs to happen. You want someone that has an educational background in business and investing, tax, finance, all of those scenarios. You want someone who's going to take a planning-based, not a product-based approach. And finally, you want someone that's going to help you with that written plan. Mistake number 2, not having a written, proven investment strategy. A lot of people would say, well, hey, Dave, how do I do that? Well, it starts with sitting down, following at your risk tolerance, and having something in writing. Doesn't mean it won't ever change, but at least you've taken the effort. You're halfway there of being able to build a good plan and following through accordingly. Mistake number 5 we see is keeping your money with your employer or former employer in your 401k when you have the option of moving to an IRA. The biggest thing I see there is you have a lot more options typically in most scenarios where your 401k may only have a small amount of choices to invest in, whereas you open an IRA, whether it's with someone such as myself or another professional, where you could have literally thousands of options. And that's what you need to get mistake number 7 taken care of, which we talked about, asset allocation. Having an IRA will help you get more professional help. Usually there's more flexible withdrawal options, so when you do need this money that hopefully you're building, you can do that. There's beneficiary options when you pass on that may not be available with your 401k plans. And there's also some tax advantages that could be involved. There's a lot of fees that the 401k charge that we talked about earlier in mistake number 1, thinking that the 401k is a free account. Well, a lot of times in IRA you can get a much lower cost fee-based management, and therefore you're saving, if nothing else, you'd have 2 things. You have more investment choices, and you're paying less in fees in many cases. Mistake number 10, and I've had this from employees ranging from big companies to little company, thinking that someone at the company they work for is watching over their account. And that goes back to what we talked about before. Years ago with the pension, someone was managing the money on your behalf as an employee. But 401ks,
IRAs in many, and just about all cases are under the term self-directed, which means that you are the ultimately responsible for making every decision regarding the welfare, maintenance, and performance of that account. And they don't have an understanding that, hey, the company isn't really there. They provided you some choices. They provided you the framework, and yes, they'll deduct the money out of your paycheck and forward it to the investment company, but they're just sitting there and saying, this is up to you. Every decision is up to you. We're just going to provide you this opportunity. So in many cases, the company is not watching over your money. They're just providing you that, and that is it. Mistake number 11 that we run into many times is people are investing in high commission-based investments. And we see that many times because the investment individuals are salespeople versus planners. Investment advisors are fiduciaries who they are legally responsible to act in your best interest, whereas a lot of salespeople, they are just looking to make a sale. You see this in many industries besides financial planning. So they're focused on getting that commission, and they're not focused in many cases on you having your goals met and building something over the time. Doesn't make them bad people. It's just a different strategy that they're building their business on. Investment advisors are the one that's going to look at keeping your costs down low. They want the long term. They want you to build your money and be successful as opposed to just hitting you with a commission and then moving on to the next person. That's mistake number 11 that we see many times. Mistake number 12 has been something just in the last 20 years that I've seen many times. Mistake number 12 is not learning from the history of the market. What we mean there is many times you see people who have said, oh, this time it's different. A lot of times I said that when I was a young kid. Oh, hey, Mom and Dad, this time this is different. Well, many times, at least in the stock market, it's not different. The stock market has a long history of going from cheap to expensive and then going back to cheap again. The larger the bull market, the longer the bear market that follows it. Inflation historically rises from lower points to higher points during bear markets. History also tells us that the stock market does well during periods of falling interest rates and falling inflation. So what does that mean in the future? Well, we don't know. At the end of the day, investors probably need to be realistic with what their returns are going to be. But at the end of the day, we don't know what the future holds. But history does give us some indications to help us plan and make intelligent decisions based on some history. Will it work every time? Probably not. But at the same time, it's like anything. If you're willing to learn from the history of the market and understand that we've been through these situations before, and while, yes, the media may make it sound like the world's ending, there is some history that can tie to these things and give us some guidance of what probably will happen at some point in the future. But really, the flat market that we've experienced since year 2000 is perfectly normal, and it might continue for some time to come. That's one reason we like to think of the approach that Harvard and Yale is doing to help diversify your portfolio and then giving you a larger return with less risk than what the overall market's doing. Remember, 401k plans are not set up to do well during bear markets when the market is down. They just don't usually have the investment choices to invest in things that will help you do well during bear markets. So if you don't have the choices in your plan, it's much more difficult to be able to hedge your bets and to be diversified going forward. So that's an important thing to look at, that bear markets and the choices in the 401ks can be very counterproductive when compared to each other. Mistake number 13, the final one, is many investors are not exploring the alternatives for inexpensive, diversified investing. And the bottom line is the goal of diversification is simple. We want higher returns with less risk. It's a simple goal, but it's not that easy to accomplish. Many years ago, in the early 90s, there was an article published in the Financial Analysis Journal, and it tested portfolio theory. And for many years, this has been looked at is over time, returns earned by a portfolio are determined by what? And they came up with 4 factors: asset allocation, how well the manager is doing with the money, how much your fees and expenses are, and the timing of the market. So out of 100% of what determines your portfolio earnings, 91.5% of your performance is based on the asset allocation that's picked between you and your professional. Only 4.6% was directly tied to the manager of the mutual funds. Fees and expenses were 2.1%, and market timing, which a lot of people think, well, I've got to time the market, was only 1.8%. So I think this goes back to what we said when we're talking about chasing last year's or the previous year's hot investments, is you need to be in that investment before it gets hot if you really want to be successful. And yes, some asset classes some years will be down, sometimes more down than others. But you will be spread out if you follow this type of theory and know that 91.5% over time, your asset allocation is going to determine what your return is going to be. So it's no wonder that many investors have struggled both during good times and bad times to achieve nice returns when they weren't diversified. Either they weren't aware of it or they just flat didn't have the opportunities in their 401k. But if you retire, if you leave your job or something changes like that, here's an opportunity to get the money out of those plans and at least explore working with a professional who's going to look at a IRA where there's lots more choices and, like as we said earlier, can be expensive or inexpensive compared to the fees that are tied into the 401ks. So I'll be happy to open up, Jeff, to any questions. I do want to remind everybody we're happy to take a look at their own portfolio and provide an analysis on their current allocation and take a look at their risk tolerance. No cost to you, no strings attached. We're not here to sell you a product. We're just offering the opportunity to see, is this something that you might want to look at some alternatives. We also, at this time of year, for anyone listening or has any questions, if you're interested in some tax planning services as well, we're happy to look at that and match that up to your investment choices going forward. These are just free reviews we're happy to do to help make a difference with our clients and anyone who may be listening after this is being recorded. That opportunity is open to you as well.
Thanks, David. I have opened up the phone lines, and so if you're listening on the phone, you can go ahead and just ask your question. And David, while I have the lines open, I'll also check and see what we've got coming through on the webcast. So again, if you're on the phone, you have a question, just go ahead and say something. And Dave, we got a couple questions here from the web. First one is, let's see. David, I have 2 401ks from 2 jobs. How do I figure out how much they overlap? And if so, can I unoverlap them?
Well, that's a great question. Number one, you would have to look at each 401k and your choices. So in other words, you start with your statement and see what funds each of them are investing in. So that's the first scenario. It takes a little detail and research to go in and then say, okay, what are the top 50 or 100 holdings of this mutual fund or fund that you're investing in? And therefore, that's going to take. So if you try to do this by hand, you're looking at probably spending a lot of time trying to develop a spreadsheet. The software that's provided to us and does an analysis, I have someone that I send this information to. They plug it in the computer that has all the major funds out there, and then they quickly can do a comparison of the different funds to see how much a person's overlapped. And that's part of the free portfolio review if someone's interested in looking at that to see. The problem is you may not have much choice because if you're in that 401k and you're still currently employed, you may not be, even if you find, geez, we're overlapped, say 60%, a percentage higher than what you want to be. Then you may say, well, okay, I need to do something about that. This is a mistake that common investors make all the time. But if you're in the 401k, you may find that you may not have really any other options based on whatever each company's overall choices are. So the first thing would be do the portfolio review to see how much overlapping you are between the two funds, and then look at, okay, do I need to try to get this money into an IRA so I can actually invest in some other options and therefore get myself to be a little more diversified than what you currently are with the two 401ks.
Okay, great, David. Again, phone lines are open. If you're on the phone listening and you have a question, just go ahead and say something. We have another question, David. Where can a person look to see what the fees they are paying are for their mutual funds?
Typically, the prospectus. Each fund is required to provide a prospectus. Now, this is usually a small book. Used to be they were printed. A lot of them, I believe, are found on the fund's websites. You can download the prospectus. This can be anywhere from 10 to 50 to 100 pages. And usually there is a section they are required to put their percentages down of the fees. You can also ask your investment advisor. He or she should be able to tell you that. But if it is with a 401k, you may find that you're going to have to go to the prospectus to find each one. As I mentioned earlier, there's the annual fee that they may or may not have. There's the 12B1 fees. There's the different commission-based on B shares, C shares, A shares, as well as there could be some other charges that are deducted from the return of the overall fund. And that's the problem. Many investors need more transparency with their mutual funds. So that transparency isn't usually on the statement, unfortunately, say, here is your cost. And that's why fee-based financial planners are becoming more and more the norm if they're really interested in the long-term well-being of their clients, because maybe they're only just paying a 1% fee and that's it. Well, there's no hidden fees or anything there. It's 1%. And it encourages, if you do well with your money, your advisor does well. So prospectus is where you have to go with the 401k to look at the fund, and there should be in there. If you need any help with that, I'd be happy to try to help find that out. Just send me an email. We'll try to help you with the research if it's not as easy for you to get.
And David, I've got one more question.
Sure.
From the internet. Says, I think this refers to item number 11. What does high commission mean when you work with a financial planner or investments?
Well, as I learned myself just going through over the years with the experience, is many of the funds dictate how well or how well and what the fees are. So, for instance, if you're selling a fund that has a high commission, maybe there's a 5% load or a 3% back-end charge or commission, those are things that need to be talked about up front. As I said a minute ago, fee-based has become the new norm because people are just wanting a flat fee. There's nothing there, as opposed to, hey, if you buy this annuity, for example, there's a 6% load or a fee tied to it. So you lose 6% of your money right off the bat because they paid a commission to the salesperson. So typically one of the questions you need to ask with any investment person is, how are you paid? What's the overall cost? How is that reducing or impacting my return? I mean, we all are in the business of making money. The mutual fund industry, the stock industry, it's a business. They need to make a certain amount of return. My feeling is a lot of those products out there, though, tend to be high commission based, and you need to know that. It sounds good, but you always need to ask, well, what's the cost? What's this really going to cost me? And weigh that, is this still a good decision? Or are there just as good of choices out there that is going to cost me less and therefore allow more of my money to keep working for me instead of going into someone else's bank account?
Well, David, those are great answers. I think we've gone through all of them unless there's somebody on the phone that may have a question. And again, you can just go ahead and speak up and ask your question. But those are all the ones from the Internet.
Outstanding.
If you're somebody is listening to the replay, David, it might be helpful if you could go ahead again and mention the two offers that they can take advantage of and how to contact you.
Sure. Well, I can be reached Monday through Friday. My phone number is 360-659-8502. You can also reach me by email, david@pettisrumseycpa.com. And we have two offers currently. One is the free portfolio review. If you're not sure what your risk tolerance or your current asset allocation is, or do each of them match each other, we'll give you a free portfolio. Here's what you're currently in. Here's some details about what you have. It'll probably be something that you've never been exposed to before because it's not from the mutual fund company. It's kind of an independent review. Doesn't cost you a thing. We're also offering a free tax planning review. Perhaps you own a business, perhaps you have some investments and you're looking, do I need to sell? What can I do but to reduce my taxes for the end of the year through your business or other options? We're happy to sit down and offer you a free tax planning review, maybe even a projection if you're just wanting to see how's my income compared to 2010. Do I need to have a little withholding, or is there something I could do before year end to save some taxes? So those are our two offers associated with tonight's webinar.
Well, David, this is great information. I think I even learned a couple of things. I want to thank you for taking the time out with this teleseminar series. If they're listening to the replay, they know how to get a hold of you. Again, you've been on this teleseminar series presented by David Rumsey, CPA, and David is president of Pettis Rumsey, Inc., a Marysville CPA firm right here in Snohomish County. So, David, thank you very much, and we'll talk to you soon.
Thank you.